Hi there, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Okay, so looking at our market today, we have closed just a little bit above 7,000, which for me is one of the key levels of our market at the moment. You can see we've hit the correction territory as of last week. Okay, so we go from the high down to the lows. We had about 11.5% correction on our market. Now, guys, look, corrections haven't really been seen since pre-COVID times. Okay, so the last big correction we saw was, roughly 50 odd percent for COVID. Then we were just in a massive bull market, and the pullbacks we did see through that period of time were quite small, maybe around 5%, 2%, things like that. So it weren't big pullbacks as quite as aggressive as what we've seen in the previous week. Although going back pre-COVID, these types of corrections happen maybe once or even twice a year. So look, they are more common than you think. Okay, and for me, it's actually quite healthy to keep markets moving, because if we don't get these corrections, and the markets go into these prolonged sideways phases, so usually, you sort of build up that momentum, the lack of momentum in the market. You get a fierce sell down on whatever reason you want to blame it on. And then usually you get a pretty quick V or even W-shaped recovery. So I suspect that this will recover a fair bit of the pullback in the next week or two. Okay, I would not be surprised to see us back up near this 200-day moving average within the next few weeks. All right, so the technical levels that I'm really watching right now, there's obviously some support through here. Okay, whether you want to draw it slightly higher or slightly lower, it's here or there, but there's a bit of a support level through this sort of 68, 69 type area. Okay, because there's various levels I could look at for that. 7,000 on the upside's the level. Okay, if we can clear through that, I think there's a very quick sort of 200-300 point rally in this market. Now, look at this chart. It's quite a bit different to what we've been seeing in the S&P 500 recently. Okay, so the last two sessions we're already up about 5 odd percent from the lows. Okay, you see here about 5% from the lows, and we're not that far off. Buying back up half of the pullback we saw through here. Okay, so the US has definitely raced in front of us a little bit in the sense of the recovery. Now, we're back above the 200-day moving average here, which is very bullish for me. I just need it through these next few little resistance and support levels here. Once we're through there, look, I would not be surprised to see it back up near 4,700 in the coming weeks. Okay, as I said before, these types of sharp sell downs is usually met with a quick jump back up. Okay, for a number of days or weeks, and then you'll go back into that slow grinding up the staircase again. All right. The Nasdaq stocks were kind of really the space that started all this off. So the higher growth sort of tech, discretionary, communication services, those types of stocks were the hardest hit throughout all of this. Okay, we saw the Nasdaq come back down near that key 13,000 level. We're creeping back up now. Okay, back to the next key level at 14,000 here, or just above. If that continues up, which I think it will over the coming week, easily can see this once again back targeting these 200-day moving average levels, something around there. So look, you'd have to be short-term bullish this market. There's always going to be a bit of a breather in between, and they've already had two very strong days, so tonight might not give us much, but nonetheless, I can't see anything really in its way for the moment in the short term. We've got the Feds. We're not going to hear from the Fed again really for a little while. Not from an interest rate hike perspective. We will see the minutes come up in a few weeks from the Fed, but I don't think the minutes are going to tell us much more than what we already know. Okay. All right. So that's the major indices at the moment. Things are looking a little bit more bullish now, and usually at least half of the pullback, half of the correction in these types of instances are bought up very quickly, and then we'll be sitting waiting to see whether it's just a dead cat bounce or whether it's the start of the next bull run. Okay, and only the news flow will determine that really at the end of the day. All right. So we saw the RBA today. Really, still pretty much on the fence, aren't they? Right. So they get end bond buying. All right. So QE's ending here. They've still got a pretty big balance sheet, which they're not talking about running off yet. Okay. So it's very different to what we're hearing in the US. The big take for me out of the RBA announcement today is they're still viewing the inflation as transitory, meaning that they are saying that the inflation is being caused by supply chain issues. Their view is underlying inflation, which is the reading they base their decisions on, will go slightly above their targeted range of 3% throughout this year, but pull back inside their range next year. Therefore, at this point of time, they're not seeing any need, and they clearly stated in their meeting announcement today that they are not intending to increase interest rates when they're completing the bond purchasing. Okay, so it doesn't even sound like interest rates hikes in Australia are on the table at this stage. They're still trying to push for wage growth, inflation to happen. They want that to come through. They want higher wages. They want full employment before they start looking at interest rates. So at this point of time, that is, bit more dovish or a lot more dovish than what we're hearing from the Fed at the moment. That's talking in a way where they're going to throw everything at inflation. So very different commentary from the RBA compared to the Fed. So with this, what I would expect is the Aussie dollar to remain weak. Okay, so through periods of time where we're expecting rate hikes in the US but none in Australia, usually leads for the Australian dollar to come down. It is already down, so I'm not sure how much more it will fall, but it will remain weak in this environment. Okay, so I'd expect a weaker Aussie dollar on the back of this. The other thing I'd kind of expect here is our market to start recovering. We haven't really joined in on the large couple of moves we've seen in the US in the last few sessions. Perhaps this bit of news might change that. We've now seen that the RBA is a little bit more on the fence, happy to wait and hold to see what the year brings. They talk a lot about supply chain issues, and for me, I agree with that sentiment. I don't believe increasing interest rates to try and battle a supply chain problem is really the smart thing to do for Australia. Okay, might be a little bit different in the US because the way their home loans and their central bank works is a bit different. A lot of their home loans are fixed for 15, 20, or 30 years, where we only really fix for 2 to 4 years. Okay, so we have a lot more people on variable rates here in Australia, which affects the economy a lot more when we start seeing the RBA switch and change. All right, so just as I was saying, the Federal Reserve's probably the one big thing everyone's talking about out there at the moment. So at this point of time, markets are pricing in about 5 rate hikes from the Fed this year. Okay, whether that becomes reality or not is going to be a different matter. But right now, the bond markets of the world are pricing in rate hikes out of the Fed, which is almost as good as them raising rates. Okay, so we've got to keep an eye on this space. We could see a lot of volatility around this space in the coming year. Okay, so obviously the Fed needs to start unwinding some of this stimulus that they put in place when the COVID outbreak began. So they're going to end bond buying. We know that. I don't think the market cares about the bond buying side of it anymore. We've seen the taper tantrums happen all throughout last year. I think that's completely old news, right? The new news right now is the two things that we've got to keep an eye on. One is interest rate hikes and how many times they're going to and how quickly they're going to do that. And the second thing is, will they run off their balance sheet? And I think that's the more scary thing to be thinking about here. There's one thing to stop supporting markets. Another thing is that if they start selling into the markets, can those markets handle it? And I think that's what's causing quite a bit of the fear and the ruckus out there at the moment. So look, for now, things will probably calm down a bit. We're likely to see, well, we won't really see an announcement from the Fed again until March. People are speculating that they will go up 0.5%. They might only do a quarter. Let's just see what the Fed does come March. It is about mid-March. We'll get about maybe 5 weeks before we even start thinking about it again. We will see the Fed minutes in a few weeks' time, but at the end of the day, I don't think that's going to tell us much more than what we already know. Omicron COVID could be at this stage peaking. Okay, so I've been keeping an eye on the weekly worldwide COVID numbers. Since December, every single week those numbers have been jumping and jumping and jumping. Last week's reading was only slightly higher than the week before, but this week's reading was slightly lower for the first time since December. This is starting to show signs that Omicron could be peaking out. Okay, so we'll be watching this like a hawk. We want to start seeing these COVID numbers drop again. And if we see that, that's going to help the positive sentiment in the marketplace. So the more we hear about this, the more they talk about this, it should help ease the mood in the market, and it should help promote a push higher in travel stocks and reopening stocks once again. Okay, so yeah, that's all showing some very, very promising signs. So all in all, guys, look, I think the market could be finding the bottom for now. Okay, we've reacted to interest rates. The market is pricing in 5 interest rate hikes from the Fed right now. So there's not much else they can throw at us to get fearful around rates again. I feel that most people that wanted to react to that news have likely reacted to that news. Okay, so unless something else comes out to rock the boat, whether it be negative reporting, whether it be something with China and Taiwan, whether it be more news around Russia and Ukraine, it could be anything, right? Unless something comes out of left field, I do suspect we've found the bottom for now in the market. I think we've seen the end of the high volatility, mindless selling. I do suspect people will move back into markets. I think we'll see a recovery in tech discretionary, but this time, I don't think it's going to be mindless buying. I think the more value tech stocks are going to outperform here. The longer standing stocks that are actually profitable. Think your Microsofts, your Googles, your Netflix that actually make a profit will likely outperform here than the more speculative tech stocks. So do I think the tech stocks could rise? Yes. Do I think all stocks are going to rise? No. I think the more profitable tech companies will be favored in this next rally. All right, which is an important little snippet to think about the next time you go out and buy some stocks. With Emerald Financial, we're already starting to put US recommendations out in this space, okay, and we're going to put more out this week. So we're slowly building up our US recommendations again. After this crash, we want to make use of the next rally higher. Okay, so last but not least, we're sort of in the middle of the US reporting season now. We're going to see big names like Alphabet, which is Google, report this week. So a lot of the bigger tech companies are coming through this week with their reporting. So far, this reporting season is not as good as the last quarterly season we saw, but it's still strong. Okay, we're still seeing good reporting. The problem is that some of the companies are talking about supply chain problems and citing future issues. And this is what could be, with the nervousness of the Fed, I think this is causing a bit of fear selling in the marketplace. So we saw Netflix the other week, fall 20% on the night of its reporting, and that would bet expectations, but people were fearful on the subscriber numbers. Okay, so this is a bit more volatile of a reporting season so far. I think things will calm down a little bit now, though, given that the fear selling has ended for the moment. Volatility is starting to come back down again. I think the rest of the reporting season will probably be a bit more steady on. Now, our reporting season kicks off next week. We'll see CBA around the middle of next week report, so that will kick things right off for us, and we'll see a lot of reporting over the next 3 weeks from the Australian market. So as the US market reporting starts quieting off, ours will start heating right up. Okay. Throughout our reporting season, I suspect our banks will recover a bit after the big sell down we've seen over the previous few weeks. So I'd be really sharp eye on the banks here, guys, in the coming sessions for a potential entry. Okay, the miners are having a bit of breather locally at the moment. You got China closed for the Lunar New Year this week. So I suspect the miners will stay a bit quiet until China reopens again. In saying that, iron ore closed on really strong highs before the Lunar New Year. Watch out for that iron ore price towards the end of this week, early next week, to see whether it can hold those gains. Okay, if it holds the gains through next week, that will bring us into the reporting. If we can see strong reporting alongside of the iron ore staying elevated, miners might get interesting again. We are seeing a lot of reports about potential staffing issues coming out of WA, though, with these miners. We might actually be seeing a point of time where COVID could affect the miners in WA. So we've got to keep our eyes peeled on that bit of news, and the miners may become a little bit volatile on the back, be a little bit volatile on the back of that in the short term. Long term, I think you've still got to be pretty bullish these miners with commodities up this high, and demand likely to remain high for commodities for quite some time. But yeah, in the short term, there may be some waves here, with a little bit of volatility around the potential staffing issues that we could see in WA if Omicron continues to persist. All right, so look, there's probably that's broadly what's on our mind at the moment. Broadly, we think market's going to be a little bit bullish, but obviously, with these supply chain issues happening, there's going to be a lot more volatility this year than what we've seen in previous, especially around any inflation data or any Fed announcements. Okay. All right, so that's it for me. Thanks for listening in today. Take care and bye for now.